Get Rich Slow with John Wolf. Hey, there's a lot going on in the economy, in the markets, in the news about health. I want to just explain one thing, and that's sort of what's going on with the Fed lowering interest rates to 0%. What's that mean to you? And does that mean my mortgage rates are going to be 0%? Well, the short answer is no, but I actually want to explain to you why and what's going on. So anyways, one thing that you might have heard is that the Federal Reserve rates control mortgage interest rates. And the Federal Reserve has a bunch of different products it sells. One of them is the spot rate or the overnight slash short-term lending rate. Other things are like 10-year treasuries, 20-year, 30-year, dot, dot, dot. Generally speaking, while they're not the same interest rate, the 30-year mortgage rate and the 10-year treasury rate do almost the same thing. So you have the mortgage interest rate 30 years right up here, you have the 10-year treasury rate right up here, and then down here is the difference between the two. So if you see, just right around 2010, there was a 1% difference or 1 point difference. And now that difference has just skyrocketed to almost 3. Now, what's going on? I'll explain that, but first I just want to show you the exact same view in a couple different levels. In the news, a bunch of money is going into the markets. Fed's cut interest rate to 0. Now, they really closed it to 0.125, but the news media likes to sensationalize everything to 0. And in a couple of the stories, I've noticed they actually round it down to 0.1, which I don't know why they don't show that it's 1/8. Anyways, here is another graph. This is absolutely live. This is the mortgage-backed securities. So if you want to go out and buy bonds right now, this is your graph for specifically a 30-year prime mortgage bond. Anyway, so in February about 20th, I knew, because I pay really, really good attention to the news, that interest rates were about to plummet down. So I called all of my clients, and these are mortgage-backed securities. So they're not directly related to interest rates. And when the graph goes up, interest rates actually go down. So it's a little bit backwards to the question we're asking. But anyways, it was really, really good. And then the absolute lowest point, the lowest interest rate you could have possibly locked in, was Monday morning last week. But between Monday morning last week and this morning, the price on the 30-year mortgages increased by about 270 basis points. Now, that doesn't translate directly into interest rates, but if you watch one of my other videos, you can buy an interest rate. That means to get the same interest rate you were looking at before, you would have to pay something like $2,700 per 100,000. And again, they're not really one-to-one. Another way of looking at it is on Monday morning, I locked a good credit 5% down client for just over 3% flat with no points on a 30-year mortgage. And today I checked the exact same facts, like the same client information. And this morning it was 4.5%. Now it's gone down a little bit since then, but that is a huge difference. So one question I'm getting from a lot of clients is, hey, if the feds are loaning money, at least in a certain way, at 0% interest or close to it, and they've lowered their rates, why are mortgage rates going up? Well, this is a supply and demand issue on several levels, and I'll address how the federal government is actually trying to address this as well. But basically, what we have here is a supply and demand. So I just want to take a second and explain sort of the basics of futures, because it's an analogy for what's going on now. So you may have noticed that in July to December, coffee is really cheap. And then for the rest of the year, coffee is really expensive. Wait, you haven't noticed that. And the reason you haven't noticed that is because of futures. So instead of a farmer selling his coffee bean crop the day that it's harvested or a few days later, which when everybody else is harvesting the coffee, if you want to sell your coffee, that's the cheapest time to sell it. That's the worst time for you as the producer. And if you're the buyer, that's the best time. But when there's no coffee being harvested at the buyer, that's the worst time, and as the seller, that's the best time. So what we as humans have figured out as a medium of exchange and time to level out coffee prices, which gives the coffee producers a higher, more predictable price for their coffee to be sold at, and it gets us buyers a lower, more predictable cost to buy it at the grocery store. Instead of the farmer selling it the day that it's harvested, what a farmer does is usually about a year before, a farmer will say like, hey, I'm gonna produce, X many thousand pounds of coffee. It's gonna be due on this date and it's gonna be of this quality. Does anyone wanna buy a contract to get it in a year? And people buy those contracts. And those contracts are sometimes bought and sold several times. And when the coffee is actually ready, then the coffee gets delivered to whoever's holding the contract. That's the super long story short, but it's actually a great thing for everybody. Now, a very similar thing is going on with mortgage interest rates right now. So there's several levels to this. So basically, when the stock market freaked out about 2.5 weeks ago because of scares over the coronavirus, which is still ongoing, the people who have to put money into investments almost on a daily basis, think of people who control large mutual funds, think of people who control large retirement funds that have to invest money basically every day. Whenever they think that there's going to be a bad weak month in the stock market, they're sort of moving to safety. And the safest investment you can buy that still has a reasonable rate of return has historically been American mortgages and their derivative, which is just mortgage-backed security. So there was a huge demand. So there was a huge demand from the people buying stocks to switch to mortgage-backed security bonds. So they wanted to buy those as quickly as possible. So supply and demand made the mortgage interest rates go down because the market was signaling, hey, we want way more mortgages available to turn into mortgage-backed securities. So then I went to work for all of my clients. I called everybody up that I've done a mortgage for, and I actually got a hold of just about all of them. And I had a really quick conversation saying like, hey, mortgage interest rates are down a ton. Is it okay if I run your credit again and lock your interest rate? I think we're gonna save hundreds of dollars a month. Just give me the okay to do that, and I'll show you what the math is after I get it locked down. And I spent the last 2.5 weeks working 80 plus hours to get that all locked in. And I actually got the last client locked in who was interested Monday morning last week. And that happened to actually be on a purchase. The next day, interest rates went up dramatically. And the reason for that's really simple. I went out and found as many mortgages as I possibly could to save my clients money. And a lot of other loan officers did the same. And a lot of other loan officers who are less proactive, but have a lot of clients, still their clients called them like, hey, I heard on the news that interest rates are low. Will you see about it for me? Anyways, mortgage companies have locked in more loans to become real loans, refinances, or purchases in the last 2 months than they could possibly have enough cash to fund. So most companies are either that you could work with as a client are either depository lenders of some type. Caliber is sort of that. They are brokerages, or they are correspondent lenders. And the main difference between brokerage and a correspondent lender is a correspondent lender has its own underwriting, but they fund loans off of a credit line, which is easily in the billions of dollars, many billions, and then they immediately sell it to somebody else who makes it a mortgage-backed security. Brokers work with a wholesale bank, like Caliber actually is one of the biggest wholesale banks. Caliber is actually one of the biggest 3 lenders, and they will sell it to us, or they will sell the contract for a new home mortgage to us or refinance to us. And then our underwriters will look through it, and then we'll decide whether or not we're going to fund it or not. And since I'm a retail arm of Caliber, it's sort of the same thing, except we're vertically integrated. So I find the client, find the loan, and then we do their own underwriting, and then we fund it. The cool thing about that is Caliber does not sell the vast majority of all the loans it writes. So when I was calling my clients back, even clients just 4 months ago, I was saying like, hey, interest rates are down a ton. I'm going to lock it in right now. Well, when I was at my last company, which was a great company, Summit Funding, if I wanted to do that and the client had a $400,000 refinance, my company would actually have to have $400 cash in hand come closing day, which is about 60 days off for a refinance, in order to fund that. The cool thing at Caliber, since my company already holds the loans that I'm refinancing right now, we only need to come up with like $12,000, $13,000 to refinance that, not $400,000. So that's a huge advantage that my company has. Anyways, so if you imagine every loan officer ran off so that they could fulfill this demand, and then suddenly there was way more supply on the we want to make new mortgages side. So what happens then is that a lot of companies, correspondent lenders, credit unions, their money available just ran out. So suddenly they have to find a buyer for all the loans in process, and the money's not there, which is why you saw in that graph that the mortgage-backed securities went way down because the supply of mortgages available went way up, and the interest rates also went way up. Now, it looks like this next move cured it, but it really didn't, because all of those mortgages that got made over the last 4, 3, and 2 weeks ago, those are going to take 60 days-ish to turn into new loans that can even be sold. And it won't be until they're sold that the companies who initially allowed those to go forward can get more cash to do more refinances. That actually is where the Fed stepped in recently. They announced that they're going to buy $200 billion of these mortgage-backed securities, and they're also going to let about $400 billion run off their books. Now, that sounds like a ton of money, and it is to you and me. No one's getting bailed out. This is sort of just money sloshing back and forth, but it's really not that much money. To give you an idea, my company is one of the 3 biggest, and we did about $3 trillion last year. And in the month of March, we're going to do about 2. And in the month of April, we're also going to do about 3.5. So the Fed buying $200 billion is super helpful, but it's not the end of the story by any stretch of imagination. So anyways, that's the connection, and that's why there's a big delay and a disconnect. Now, if the economy slows down, which it's likely if people are in quarantine that the economy is going to slow down, then in the coming months, the interest rates will move more in the direction of the mortgage-backed securities. I think that's honestly going to take about 2 months, but that's just a prediction with not a lot behind it. If you are interested in doing a refinance, the best advice I could give you is get with somebody who's really active and watching the markets like me. What we would do is just get your loan ready so that it can be locked when it's a good time. Because it's actually a ton of work to get these locks done. So your less attentive loan officers, credit unions and such aren't watching the market like I am. Anyways, have an awesome day. Take care. And I am a mortgage loan officer in Oregon and Washington. So if you would like some help, please look me up for that. And like, share, and subscribe to this channel if you thought it was useful. Have an awesome day.